Difference between active and passive investing. Active investing is a style of investing that involves buying and selling securities in an attempt to outperform the market. Investors are those who believe that it is possible to select securities that will outperform the market. They believe that they can identify stocks that are undervalued and sell them when they reach their true value. Active investing involves buying and selling securities to profit from fluctuations in their prices. These investors are also known as stock pickers. They may buy stocks in companies they believe will outperform their peers, sell stocks they believe will perform worse than expected, or both. Investors may be professional traders or individual investors with a small portfolio. They are often contrasted with passive investors who buy and hold securities for long periods of time without any trading or market timing activity. Investors who engage in active investing may use a number of different strategies to try to outperform the market. These include using technical analysis, fundamental analysis, and quantitative trading. Active investors may also be more likely to make adjustments to their portfolios based on changes in economic conditions or company performance. Active investment strategy is an investment strategy that involves buying and selling securities within a portfolio over time. Passive investing, on the other hand, is a strategy that involves selecting investments based on their ability to match the market's performance. Passive investing is an investment strategy that is based on the idea that most stocks are not worth the time and effort it takes to monitor them. Passive investors do not have to spend their time or money researching individual stocks, deciding which ones to buy and when, or monitoring their investments on a daily basis. This investment strategy seeks to provide positive returns through capital appreciation by investing in securities such as stocks, bonds, and other assets without attempting to beat the market by timing purchases and sales. Investment in passive funds has grown over the last decade with the growth of ETFs and index funds. This has led to a significant increase in the number of investors who use a passive investment strategy. Passive investment strategy is an investment strategy that involves buying and holding securities in a portfolio for long periods of time. Investors are not concerned about short-term market fluctuations. They are focused on the long-term growth of their investments and will not react to short-term events. Clearly, active investors are more aggressive than passive investors. Active investors buy and sell securities frequently in order to try and outperform the market. Passive investors, on the other hand, will invest in assets that mirror the market's performance. Investors use active strategies to try to outperform the market, while passive investors are more interested in capturing market returns. The two strategies have different objectives and therefore have different strengths and weaknesses. Active investors look for undervalued stocks to buy, while passive investors look for the best performing stocks without any regard to price or value. The main advantage of the active approach is that it can generate higher returns than passive approaches because it's able to exploit market inefficiencies by making bets on individual securities or sectors. The main disadvantage of the active approach is that it requires more research time and greater knowledge about markets than passive approaches, which means it's not well suited for people who lack these skills. Thank you for watching my video.